Hello and welcome to the Trading Zone. I am Joe Teagay, and with me, of course, is Brian Stutland. We are portfolio managers at Equity Armor Investments, former options market makers on the CBOE, current managers of the Rational Equity Armor Fund, and experts in all things volatility, just watching the market. Brian, I see you got your Bulls shirt on today.
Yeah, yeah.
Not
The reason I have it, look right here, 1996. You know why I have that, Joe?
uh,
1996. So obviously, great teams, the Bulls. The 90s were amazing runs by my Chicago franchise, the dynasty. 6 championships in 7 years. But more importantly, I kind of feel like and this is what our show is going to be about. Actually, folks, we're going to talk about sort of a year in review, what the markets have done this year, where we think they're going next year. We're kind of wrapping up our shows. We head into the Christmas, New Year's time, and Joe, I feel like this year is 1996 all over again, or 96 maybe coming next year, somewhere around there, right? I feel like we are 96 right now. You
mhm.
talk about things in the market, Joe. We saw the Fed cut rates 3 times, right?
Well, you can look at the year right here, just so you know.
Yeah.
This was quite an eventful year for volatility. The market did just fine, but of course, volatility happened, and I think we should be expecting more and more of that as we go on here. But yes, this was absolutely a volatile year, but also a good year for equities.
Yeah, really good year for equities. Just looking here, S&P 500 year to date up about 16% over here on my screen currently. So obviously a really good year. Kind of like I mentioned, the reason I feel like it's 96, if you look back to the 90s, the Federal Reserve cut rates twice in 1995. They cut it a third time in 96. And then at that point, rates actually ticked up a 25 basis points in 97. So what did we see with the equity markets? Very similar levels of volatility back and forth. Some eventful things happen, but ultimately equities had a very good run, moving higher. In 96, the S&P was up about 19% that year. And from 96 to 97, up 56%. So really good time to be long in equities. Yeah, right there, right? So I kind of feel like we're in the similar structure. We have a technology revolution. We have the Fed that had cut rates about the similar amount of same amount relative to each other. We're probably getting one more rate cut next year, and I think things continue. Not that we could get bubbly. What do you think, Joe?
Yeah, and I think this is kind of just like a good thing to kind of remember and visualize. Like, as much as we like don't like it or like think it's inevitably going to be harmful in the long run, it feels like that central banks around the world, not only our own central bank, but in governments around the world too, alongside their central banks, they are in the business of keeping the economy moving well. They're in the business of propping these things up. It's just one of the reasons why the dollar depreciates in value over time. But it does mean that assets appreciate in value over time. And it's just kind of set up to be the case that in America happens to be the largest country in the world, economy-wise, the largest military in the world. It's kind of set in our favor, and we happen to have the greatest companies in the world. We happen to have the best technology in the world, and this kind of rigged system where money is flowing here. And I am okay with that. I think we just have to accept that. It's just we have to be prepared for some volatility along the way.
Yeah. Well, folks that are tuning in live, I'm Brian Stutland with my colleague here, Joe Teagay at Equity Armor Investments. We give our opinion about the market every week. We're going to kind of gear this show into more of a year-end review and kind of a look ahead. We brought up the idea of 96. I guess I'll pose this very first question on the show, Joe, to you. Next year, do you think this is 96, 97 kind of move continuation of the equity markets? Or have we kind of seen our run and we can't really make new highs in the market right now, which we're seeing in this month of December? It seems like the market rallies and then just kind of fails. Or is that a warning sign for you? Or do you feel like the run still continues into next year?
Yeah, I think this is health. This is what I want to see. I want to see this healthy growth here. I mean, I'm not gonna be sorry if this happens, obviously, but I don't anticipate that happening. This is where your healthy growth. This what happened here was some just excess liquidity thrown at the market. They saw a fire, they dumped some water on it. And they didn't realize what was going to happen with all that excess liquidity. We just went, this by the way was irrational exuberance over here. So if we have irrational exuberance right now in the market, like God help us if we have whatever this was here. So I'm not going to be upset if this happens, but I'm just going to be prepared for either scenario. I'm thinking my base case is that this isn't go this eventually is going to deviate. These two patterns here, we're not necessarily going to get exactly this pattern. I do think though there will be excess liquidity thrown on the market. Not necessarily.
Does that happen? Does that happen next year? The excess
I think it could happen next year. I mean, it seems like the Fed is being strong armed, or maybe the refs are being worked very strongly, or maybe new individuals will be put in place, which will be favorable to growth, which kind of seems to me like it might be excess liquidity coming in. It might not be like a emergency liquidity. It might just be extra liquidity just for fun, and I think that will fuel some market gains.
Okay. All right. Well, I mean, let's turn the page a little bit, kind of like looking back. If this pattern can repeat itself, let's just say, because it sounds like you're on that side of the thing. I for one am also a very big proponent that we are this is a repeat of the 90s. Thus my Bulls 96 final shirt. But let's just look back. Let's just look back, because obviously Bitcoin, some of the other higher growth names in the recent weeks have kind of struggled. I don't know if you can pull up a chart, Joe, of what Bitcoin has done, because I feel like this has been a leader, or maybe SMH, the semiconductors, where they're going. There's obviously been this huge talk around Oracle. There's a bubble in the sort of cyclical financing. We've seen Oracle, some of the data centers now saying that they're going to have to push off till 2 years down the road, that OpenAI may not be able to sort of make good on everything that they wanted to do. And that's given some level of concern. I mean, Oracle is kind of a funny one. I mean, that thing is trading like it's like Enron to me. And I don't know what's going on with that. Maybe it's just a nuance that everybody just wants to hedge one name and they're picking Oracle as the name to hedge, and it's getting beaten down for it. But yeah, here, take a look at SMH. Is this kind of movement a topping pattern for you, Joe? Do you think? Is there more
Not
downside?
necessarily.
Like
It definitely has had. It's had a big correction here, big pullback. But we've seen lots of these big red candles here. So it's just some nice consolidation here. Maybe we got a little bit too far ahead of the 50-day moving average here. But this just seems like regular consolidation here. We see a lot of this volatility. This is something we have to accept when we're looking at these semiconductor stocks.
So you're not worried that it's like a May, like if you kind of go back to April, March, April, granted the tariffs were a situation there where you saw these long down candle moves, it kind of protracted for a lengthy period of time.
Mm-hmm.
Do you see these kind of, red warning signs pop up? Do you think it's like the last few months where this is going to be a buying opportunity? Or can this trigger on what is it that's going to trigger it on, like a market?
Yeah, I mean, if by going back to our 96 to 2000 analogy, like there were quarters where we saw this is not impossible to happen. So even if we are still in the major bull run, we could still see this. We could see something like a pullback all the way down to the 200-day moving average. So that could be something that is absolutely something we have to be concerned of. And when you talk about Oracle, is a great company to bring up because that is the concern. There's the circular financing people are talking about. NVIDIA's giving money to OpenAI, which raises its valuation, which allows them to make deals with Oracle, which raises their valuation, which allows them to take loans, to buy more NVIDIA chips / build new data centers, et cetera, which causes people to raise some worry. But let's just bring up Oracle as a stock real quick, just kind of to visualize this. So that that announcement, Oracle said, "Hey, we got all these new deals with OpenAI coming out." That led that stock to jump up here to 350. Maybe it made sense, Brian, that hey, this was kind of fluff. It doesn't deserve to be up this high. I want to see these OpenAI deals come to fruition before I give them this type of valuation. But now that we're below this level here, that seems like a little bit of overkill here. And I don't really understand it. And here's why. I just want to bring up just one chart here, just um, kind of throw it out here for comparison. Let's take a look at this company here. Closer to its all-time high here. But do you know Rocket Lab, Brian?
Why don't you tell the viewers what Rocket Lab is?
Rocket Lab is a cool company. I think it's a very futuristic company. Looking at like a 30 billion valuation here. It doesn't make any money. It does make rockets, and it's going to be launching rockets in tandems with SpaceX over time. And they're likely this run up over the past month here is about people talking, including SpaceX, but people talking about this company launching rockets to space to build data centers. Now, this is just all hypothetical. This is all future, but we're giving this company credit for data centers in space, and yet we have the company Oracle building data centers on Earth, which is getting hammered. So that's where it kind of confuses me. I think I'd rather have the data center on Earth for now, but. And I do think that's just kind of like things kind of just get caught up in this fluff. Like it's probably somewhere in between. This company might not be as good as it seems right now. Oracle's probably not as bad as it seems.
I gotta look up what's the surface temperature on Mars out of curiosity.
I don't think it's going to be in Mars. I think we're just talking about
like just like a satellite that's going to orbit the Earth, and I mean it makes sense, right? That's natural cooling, right?
Well, you don't need water. You don't need it's much cheaper to operate. I think you get much more efficient solar electricity in space too. And there's cooling is not needed. I don't know if you need to heat these things up. Maybe it'll be too cold to operate. I don't really know how it works.
Well, actually, just look at it. So the surface temperature on Mars is -80 to -85 degrees Fahrenheit, with lows as low as 243 degrees Fahrenheit at the winter poles. So you could get to Mars and build out a whole thing, right?
I don't think you need to go to Mars, though. You can just do that in orbit. Just build like a data center station. And you could make it orbit so that it's always in sunlight. I don't think Mars.
I mean, I guess the only one thing I would say about the chart you brought up is like, are people thinking that the idea of data centers on Earth are out, and if you really want to build this whole thing out and make it energy efficient and actually do,
I think people see the future that we need more data centers. This is a very good solution for energy efficiency, water efficiency, electricity efficiency. People just don't want data centers in their backyard, etc. It's a good solution. We're thinking, 5 years down the line, how are we going to keep on building these data centers if we can't build enough on Earth? That said, if that's true that we need all these data centers, we also are going to need them in the short term on Earth. So I think if that thesis is true, if people are convicted enough on that company that is just building for the future, I think there should be more conviction in a company like Oracle that is building for today.
I think that makes sense. I mean, maybe it's just this whole Oracle thing is just pull this back to the norm. Let's see real results. I know you've had all this build up announcements, data centers are coming, but the fact that you're telling us like some of the production is delayed a couple of years down the road, the fact is they did take out debt to potentially build this out. And if like OpenAI fails to deliver, now they're holding this debt that was supposed to be meant towards a build out. I guess they just pay the debt back, right?
And what they're building, I think they're getting hammered because they're not able to borrow more to build even more. They want to keep growing faster, but I don't think even if OpenAI does not step up to the plate and fill all these data centers, that they will not be replaced by someone else who is looking for capacity.
Right.
There just is not a single chip out there in one of these data centers that is not being used right now. So I don't feel like if they fail to build more, if they fail to build more, that'll like limit their long-term growth because all these data centers are making so much money. But the ones that they've currently built and borrowed on will be profitable.
Yeah. All right. Well, I mean, we still hold Oracle a small percentage in our portfolio for clients. I mean, we're still a believer. You brought up this chart here on Google. Let's talk about this over the last year. Obviously, tremendous run. Does this run continue? Does it just need maybe a little pullback, cover some of these gaps here, anywhere from 280 to 310, and then Google is really your AI of the future? And if
Yeah,
that's the case, and OpenAI is not.
I think this is the handoff from NVIDIA to Google, like leadership in the AI trade. I think you're kind of moving from the hardware component into the software component, where it just also seems where there in the AI world there is like a marriage of hardware and software, which is different than in previous tech revolutions we've had. But Google is there. NVIDIA has like a leadership, of course, there, and NVIDIA will still perform quite well. It's just the market's expecting it to perform quite well. Google does not, even though it's had a fantastic run, it still does not have like as high of a valuation as some of its AI peers. But for me, Google has its fingers in all of the right AI pots. It is and I think it's just doing the research for the right way. It's not doing like a short term, like cash grab research on any of it. It's doing like the long term, like what is going to be like a useful technology research that they're doing. And then they'll figure out how to make money off of it later. It just seems to be working for them time and time again. I love what they're doing with their driverless tech. That's, of course, AI. I love what they're doing. With their quantum computing. They're the leaders in quantum computing, which is extremely exciting to me. And it's easy for me to just pick Google because it's super hard to understand exactly what's going on in quantum computing. But I know Google is spending a lot of money on it, and I know Google has some of the best engineers, scientists, physicists in the world working on it.
Yeah, for sure. Yeah, I really think it's probably a leader here. Just speaking from the technicals, probably could draw like a support line, maybe going up from like the June timeframe or so to where we are now. It seems like maybe what's that blue line? Is that the 50-day moving average?
Yeah.
Yeah. So I don't know. I guess maybe a 50-day moving average pullback is probably needed for the stock. I wouldn't sell my stock though. In that, yeah, see, it looks like it's tracking right at that 50-day. So I mean, unless it starts going hyperbolic, then then we can keep going.
Mhm.
But I still would want to hold this as probably my number one stock. Let's talk a little bit more about the Mag 7 this year, because they're a big whole percentage of the S&P, and if we're going to get a 90s style continued rally, we need the Mag 7 to keep doing what they're doing. Tesla is a name that maybe first half of the year kind of struggled, lagged the rest of the Mag 7, was down most of the year, has had a nice run lately. What do you think's going on there? Are you a buyer of this stock?
Yeah, so crazy story, of course, with their huge pay structure given out to Elon. And a lot of that talk was, is it worth it? Like, how can one person be worth this so much money? Well, I think the answer is just because he has other projects going on, and you have to think in order for Elon to reach these payout structures, he's going to have to bring some of those other projects in and give Tesla a better deal than they otherwise would get to get into that race. So if you think about OpenAI, let's say OpenAI and it continues to succeed. They're on par with Google, and they continue to increase in valuation. We're talking about a company that's anywhere from like 500 billion to $1 trillion in value for OpenAI, and growing. What would you think a competitor to them like the XSLM, Grok LLM, what would they be worth? And certainly seems like they're going to be necessary to achieve some of Tesla's products, to have some sort of language model built into some of that. So that is that's a component to it. Of course, we talked about the data centers and SpaceX, so that's a component to it too. Like, they're how are they going to get all this storage, or how are they going to get all this computing power? So yeah, this absolutely is all playing together, and it's kind of exciting to me too. I do love the vision that Elon is putting forward. He seems to understand the bigger picture, and putting all the pieces together. And I do like to see the picture that they're painting. And again, another thing like Google, but it's just kind of like hardware with the software combined, like the AI in some sort of component. We know the driverless cars is a big thing for that, but able to do robotics, you're going to need the same technology, which is why I think people are really excited about this company.
Yeah, certainly. Stock up almost 4% today. Obviously, you mentioned the progression in the robo taxi autonomy spills over into the robotics area, because you do need that same technology. The momentum behind it has probably triggered a lot of buy zone, actually. If you look at that chart, it looks like it might be breaking out to a higher level. And then obviously there's been some very bullish scenarios that have come out from Wall Street on recommendations for the stock. So I think it's the full self-driving. We continue to see more cities get that. They take more market share. They could make some headway here. Tesla's a stock I want to own. We continue to own that for clients. And I like it. I like what they got going on. Should be interesting times over the next couple of years on where the robotics side of things go, to see if that actually can deliver. Obviously, Musk is a big proponent of that, because that's probably where his payout package is going to come from. If that actually develops and takes off, the target numbers that are stated in that package will be able to be met with that. So, one other area though, Joe, I'd like to look at is like sort of turn the page, because it's kind of interesting, more short-term dated. Obviously, the first half of the year, we had everything about tariffs that kind of all shook out. It gave it a little carpet shakeout to take us higher. One thing that's interesting lately, because we talked about the Fed at the top of the show cutting rates, XLF, the financials. I don't know if you can bring up a chart on XLF here, but are banks something you need to hold? If interest rates are going lower, does the 10-year rate stay where it's at? The yield curve gets steeper. Does it look really good for banks right now? Would you be a buyer of financials?
Yeah, absolutely something we need to hold. This chart actually is just like a really good chart.
That's a great head and shoulders, like, I would say almost like a head and shoulders bottom. There's like a big cup and handle, a long handle here, and now we're busting out.
Yeah.
If I had sort of a price target, so that the purple is the 200-day moving average, right? So 51.50, top after 54. I don't know. I think, do we get to 57, 58, maybe another 10% or so, maybe to the upside here before it kind of slows down?
Yeah, no, I do like that target. But just in general, just seeing the strength here in financials, I think that's just a sign that the economy is going to be just fine. It seems like the market's going to be just fine too. So this
credit was really a problem in the market, right? Financials would not be doing this well.
No, absolutely not. And deal making for a lot of these AI related issues is really accelerating right now. So that's another exciting thing too. And if we are in the second half of the 90s .com build out, then yeah, we will be seeing more deal making, more of that corporate structuring excellence from the banks happening. So that's an exciting part to me, and that's a sign of real stability in the economy for me, saying, hey, this does not look like it's any issues going on deeply in the economy, which is really going to be what when the bubble pops is going to be when the economy slows down to a halt, and we can no longer sustain it. Now, it might be the case that things get too hot, and then inflation is no longer able to be kept in check. That's a very real possibility, and that might be what forces the Fed to finally end their dovish stance and easing policy and start to raise rates. That's one thing, but it's going to have to be the economy slowing down, which is the end of this AI run. And this banking strength is just a sign to me that this economy is not showing that sign of weakness.
Yeah, we always had a thing on the trading floor, like don't fight the Fed. The reason being, like, Fed starts to cut rates. Sometimes the first initial cuts, well, if the market has kind of struggled, the first initial cuts are usually the market's like, oh no, I need to give me more liquidity for me to stabilize. And then it kind of takes the Fed saying, okay, we're done. We don't need to cut anymore. Things are looking good. And then the market really rallies. In this case, the Fed started cutting when the market was already at highs. So it's a little different. It's kind of interesting to see. We don't have like an XLF ETF that existed in the 90s. So it's hard to know like what banks did exactly back then. But since they actually officially launched the XLF in 98. But I will say this, I think if you get a steepening yield curve, it does turn out to be fairly decent for banks. I like names that we hold for clients. I like names like JP Morgan. HSBC is kind of like a maybe alternative bank that you normally don't think of, but I actually still like that. I'm not saying it's your top holding. I like Wells Fargo, even in this kind of environment with the steep yield curve, is a good buy. So that's something that we just got in recently and rotated into. So I think financials have a little bit more upside. I think they have a place in the portfolio. And if this is the 90s, I want to own some of them.
Yeah, 100%. And yeah, it's gonna level out the whole portfolio too. We can't all be AI, but there are so many areas in the market which are benefiting from AI. So it's not solely a tech trade; it is a whole broad economy trade.
Okay. All right. So normally in our show, we do give a trade of the week. You can go to equityarmorinvestments.com, click on the trading zones, be a subscriber. We are actually coming up in next year going to be on Substack and X. Actually, you can pay extra for a subscription and get that information as well through that vehicle. So you don't have to go to equityarmorinvestments.com. So that's kind of exciting for us. So check that out. Look for that coming up in 2026. But before we get that, we usually give a trade of the week per se, since we've kind of used this show as really like a year-end review and a look ahead kind of show. We're not going to give an actual trade. But I would say if I had to do a trading zone trade, Joe, just looking into the very end of this year, from now until Christmas, everybody kind of expects the Christmas rally. It doesn't seem like it's really materialized. The market's been stuck in the mud. Is there really a trade you're looking at that where it's a stuck in the mud trade till the end of the year? Because I think both of us are probably on that page, or maybe you're not. So
not the end of the year, but the end of the week. I think there are some expectations for some movement this week. We do have some big events. We got CPI, we got the jobs number coming out, but it is a witching week, Brian. It's a triple witching. There's a lot of there's a lot of options that will be expiring at the end of the week. This is like the kind of people. Some people just say, "Hey, I just want the only D's option." And that'll be it for the year, and I'll own that. So a lot of people buy these as leaps. So there will be a lot of options expiring this week. Sometimes I think that leads to just a ceiling on where things can go because the market has a hard time getting through some of those levels. So I think that actually will be unwound next week. I think the market could rally next week, but this week I expect the market to sit where we're at. So I did sell the 30 Delta Strangle for the week. And here was it. The strikes that it came out to be, it was the 687 call, the 675 put in the SPY, coming back with a 430 right now credit. That would be one option. I think you can make it a little less risky too, if I were so inclined, maybe to. Yeah, that's the wrong one. If I were so inclined, I can make it a condor by adding on this outside. Yeah. There is a 690.
Yeah, so the condor is you sell a strangle on the inside strikes, like ones that are closer to the money. You buy put in a call strangle on the outside strikes, ones that are farther away from the money. Right there, you see
a lot less risk on this one. This has a max loss of 5, but we can bring in 211. I can bring in 211 right here.
Yeah,
If I did it right here,
that's a really good risk reward, if you ask me, honestly. Great.
yeah, I think it's going to be very likely in between there. So
yeah, I like it. All right, so tune in. If you're a subscriber on the Trading Zone, you'll get that specific trade delivered straight to your email inbox. We are here every Monday. As we head into the end of the year, though, Joe, this is going to probably be our show for the year. So
yeah, it's the last full trading week of the year.
Yeah, that's right. So tune us into the new year on Mondays, and so we look forward to it. It's been a great show. It's been a great year for the markets. We'll see if this can return next year. We obviously think so. I'm Brian Stelton here at Equity Armor Investments with my colleague Joe Teague. Make sure you check us out on X at Brian Stelton or at Joe Teague as well. Check out our YouTube channel at Equity Armor. Subscribe, like, everything else that everybody says. We'll catch you soon. Thanks for tuning in.
Have a good one.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.